let's go back to our trade tab here just for a second. We've gone through a couple different scenarios. What I want to do now is just set this trade up for you and then talk about the entrance and other kinds of criteria. Basically what you do is you start with the front month option. In this case we're in July. But I want to make it clear too that this is an option strategy. Now it could turn into a stock strategy, but right now it starts out as an option strategy. So you have to be comfortable with options to begin with. But if you're watching this video, I'm guessing that you probably are already somewhat familiar with options, and if you're not, there's plenty of good resources out there to help you get familiar with what options are. Basically, options are simply financial instruments that you can buy and sell around a particular issue of stock that helps you basically manage risk. Some people use them for speculation purposes. You know, if they think a stock is going to go up a lot, they'll buy a cheap call. They'll buy some puts if they think it's going down. But they're basically hedging and risk management financial tools. What we'd like to do, and it's very, very simple to get this thing started, but I'm in my Thinkorswim platform, and what I do is I set up my advanced order way down here, down at the bottom here, to first triggers sequence. And what I want to do is I want to be able to go out into a far month, generally a time period in which I think, in fact, news is going to break on the stock, this particular stock that I'm targeting. So in the case of Yahoo, if you take a look at the time period between February and July, February was the month in which the news came out, and now we're in July, and some more news has come out about that. What's that? February, March, April, May, June. About 5 months, because we're still in the beginning of July here. So if I can go out another 5 months, that will probably give me the time that I need in order to determine whether or not this is going to be a viable strategy. And in fact, Yahoo will in fact get an offer for their stock. So if I go out July, August, September, October, a November would be ideal, but we don't have a November. We've got October, and then we've got January. I'm not so sure I'd like to go out as far as January. So I'm going to start with October. And what I want to do is a basic strategy of buying some calls that straddle the current prices, just a little bit above the current price. The current price is $21.89. So I'm going to go ahead. Let's say I want to buy the $25 calls, which is just a little bit above. I could have gone with the 22.50s, but I'm a cheapskate, so I want to buy a little bit less expensive calls. So I'm going to go out to the 25s, which is just about $4 above the current price. I think and I believe that $30 or higher is probably going to be the offer that is going to be made on Yahoo if somebody makes an offer. I'm not saying, in fact, this is not a recommendation to buy Yahoo stock or to do anything with Yahoo whatsoever. This is only for illustration purposes because there's lots of stocks out there that are in the news. Lots of talk, lots of rumors, and this is the kind of thing that you can put on any of those kind of stocks. If you can find the favorable conditions. This is what we're going to talk about right now. So I've got the October 25 call here, and because it is a back ratio spread, technically you could say it's a back ratio spread. I tweak it a little bit, and you'll see how I do that in just a few minutes. But I like to buy a longer dated option. October, in this case, we're going to go a little bit above the current price of the stock, right around 25, and we're going to start out with at least 3 of these right now. Then what I like to do is go back and do something that's counterintuitive, and that's to sell an in-the-money call. And I know what you're thinking. You're probably thinking, wow, you're selling an in-the-money call. If you know anything about options at all, it means that when somebody sells you, when you buy a call, you have the right but not the obligation to purchase the stock at the strike price that you have purchased. In other words, if you buy a call at the July 1750 strike price, that means it gives you the right in the future to purchase shares of Yahoo stock at $17.50. You're not obligated to do that, but you can do that. It gives you the right to do that. But what we're doing is we're not buying them. We're actually going to be selling one of these. So we're going to set that up. We're going to actually sell one of the 1750 July in the money calls. Now, this is part of the risk of this trade, although it's fairly minimal. We are going to be putting on both of these trades at the exact same time. The 3 October Yahoo calls at $25, and we're going to sell one of the Yahoo July 8 1750 calls. And we're putting them on at the exact same time. For those of you who know options, you understand that if you sell an in-the-money call, the potential is there to have the stock assigned to you. And what that means is that if you sell one of these contracts, the person who bought the call, okay, the person that you sold it to, or maybe somebody else, anybody who's long that call can exercise their option, and randomly you could be picked to have that stock sold to you. So you would automatically have a short position in the stock at 1750. However, you're going to have these 3 calls in the October 25 strike price as protection against the short stock that you might be assigned. However, that doesn't happen too often, but it is a risk. But it's not a risk in a bad way, because as you'll see when we go ahead and do our analysis of this trade, the risk is really extremely minimal. So let's go ahead and go back to our analysis tab. I'm going to go ahead and analyze this first, just the 3 October 25 calls that we're purchasing. And look what happens. We have a very similar risk-reward, profit and loss graph that we did when we purchased an outright call on the stock itself. In other words, we have a maximum loss here of $411, which you can see is the green line, which is our expiration line for this particular option, which is in October, expires in October. And we also have the white line. Our white line is our current profit and loss graph. So if we were to purchase the October 25 call right now for $1.37, if the stock moves up, we follow this white line and we would actually profit from that. If it moves down, we're going to obviously meet our maximum loss, which is $411 on this trade. Like I said, not a bad scenario, but you know what? If you do these more than 2 or 3 times a month, I don't want to lose $400 on each trade that I do. So let's go back to our trade tab for a second. Now we're going to bring over the one call that we sold at the 1750 strike in the near month, which is July. All of a sudden, our graph looks extremely different. It looks much different than it did just a second ago. Let me take that out for a second to show you the difference. That's with selling one of the July 1750 calls, and that's without selling the July 1750 call. That's maximum loss of $411. Yes, we have unlimited upside potential. But now look what happens when we sell that one in the money July 1750 call. All of a sudden, we have a scenario in which our maximum loss, if we take a look right here in the center, which is the low point of our expiration, green line, our green line is our expiration of $50. That's it. That's our maximum downside risk if nothing happens in this stock. In fact, if the stock trades down a little bit, let's say the deal doesn't go through and the stock gets sold off as a result, we can actually make 60, 70 bucks if the stock trades down. What happens if it just falls apart completely and goes all the way to $5? Well, at the most, we can lose only $11. That's it. That's our maximum loss. Unless we stay right around this level here and absolutely nothing happens, we lose about 50 bucks. However, the important thing to consider is the fact that we have unlimited upside potential on this particular trade. This is what separates this kind of trade from any other trade that I've ever seen. And what it does is that, yes, I mean, you're not going to get the total profit potential. You know, if you had just those calls out there, you're going to make maybe $1,000 at expiration on these, but when you sell these at $30, you're only going to make $624.